Good morning, everybody. It is Friday, July 3rd, 2020, and I hope that you are enjoying your freedom today and tomorrow and the next day and every day after that. I'm going to talk about several things today that all dovetail into our investment themes and talk about some of the newer things that I'm doing with the services because I know that some people want to be more invested most of the time, and they don't want to take the cash positions that I typically take. So we're going to offer something that's a little bit more expanded than what I've been doing. And because I do manage a lot of ETF portfolios, give you a little bit broader approach to sector rotation and just staying invested in whatever bull market is going. It requires more management for you. It's not a set it and forget it thing, but if you want to perpetually readjust your portfolio to be in the 5 or 6 or 7 best places to invest from an industry standpoint and sector standpoint, it is very doable. And it is something that I've done for years and years and years to beat the stock market by anywhere from 4 to 8 points a year on average. It does not require single stock risk, does not require options or leverage. It's just a matter of making good qualified decisions based on what is relatively strong versus what is relatively weak. And usually those trades last, a couple of months on the short side, but usually anywhere from 6 months to a couple of years. So these are not day trading things. They're not even really swing trading things, but they're ways to just stay mostly fully invested most of the time. Take advantage of the point of the fact that the government either prints money or prints a lot of money. We never contract the money supply. Sometimes we flatten it for a couple of years and the market goes sideways to let things catch up. But we really haven't seen in 40 years a prolonged period of money contraction. And given that the velocity of money at this point is so low, there's a pretty good chance that once we get through the unemployment problems that we have right now, the economy really roars a year or two from now, post-vaccine, post-coronavirus. So while I've been very bearish coming into this year, I'm now looking for places to buy. However, I think that it's pretty clear, and we'll look at the charts at the end here, that the stock market is overextended. It is reflecting a euphoric approach to investing that doesn't make a lot of sense economically. And there are major problems out there. One in particular that reminds me of just before the financial crisis, and another one that reminds me of just before the emerging markets crisis back in the late 90s. So we have some major problems out there, and they're going to take time to work through. While we work through them, there will still be sectors of the economy and industries within those sectors that do pretty well. And we'll, like I said, we'll focus on that at the end. And that really dovetails with my whole investing in the 2020 special report that we put out at the start of the year of the places that are going to do well as the economy becomes more subject to machine learning, artificial intelligence, the Internet of Things, and now the work from home economy. So what I expected to happen over the next 10 years, and I had warned you not to get frustrated if it didn't happen in 2, now I think is going to actually happen in 2 or 3 years. So a lot of the things that I thought would take till the end of the decade to happen are going to happen by the middle of the decade. We shaved 4, 5, 6 years, 7 years maybe off of some of these time frames, from people working remotely to electric vehicles even. So there's a lot of things that are changing, and suddenly they're changing faster than we expected again. And it seems that every time that we're prepared, the world speeds up. And sometimes it's government, this time it's a pandemic, sometimes it's a financial crisis. But the reality is that changes are constant. And within change, we have to adjust our investment style. So today, on the eve of the 4th of July, Independence Day, I want to talk about wealth inequality just a bit, because ultimately it reflects on our corporations, which means that it reflects on corporate debt, which means that it reflects on the stock market, which means that it really reflects on everybody because of the wealth effect and that impact on the economy. And there's a website I ran into probably 10 years ago, just very simple title, Who Rules America? I believe every 2 to 4 years he updates the data on this website. I would really recommend that you go and check it out and read this report, because it really talks about the flow of power and money. And it doesn't quite read like a good novel, but I think you could take these ideas and turn them into a novel, with your evil corporate guy and your corrupted politician, and your complicit family members who just take the money and live the high life. I mean, you really could take these numbers and ideas and go, huh, boy, I've seen that in a bunch of movies. So take a look at this website when you get a chance. I think it'll be enlightening to a lot of folks. I think it'll shed some light on some of the things that I allude to repeatedly, that I try to scale down because I don't want to get too political. But the reality is that we have had a pretty severe shock to the system again. And like 2008, it seems like only about 20% of the people are going to benefit from the, the, the medicine. So the medicine that we're pumping into the markets and the economy seem like it's going to be heavily skewed towards investors, the top 20% of the earners, basically us. And we have to think, okay, that's good for me now, but does that hurt me later, right? If wealth inequality gets too rough, what happens on the snapback? And what we know, and this article is from late last year from the Washington Post, is that wealth concentration is basically at the same level. And I think with coronavirus, we've got to be there by now with all the largesse from the Fed. Wealth inequality is just off the charts at this point. And we have seen it manifest partially in the protests from both sides. You had the Open the Economy protests back in May, and that was largely from the right of the political spectrum. And then you had the George Floyd, Black Lives Matters protests after that. And I would suggest, and I'm not the only guy out here saying this, that both sets of protests ultimately stem from a frustration of an inability to get ahead for many, many, many years for many, many, many people. So what ends up happening when enough people get fed up they can't get ahead? Well, I think there's a couple of things that happen, and one is we see these protests, but the other thing is that politicians get elected in to take even more extreme actions. So while I have lamented the fact that we gave massive tax cuts to the super wealthy a couple of years ago, and that led to massive multiple expansion in the stock market, not supported by revenue or earnings, basically setting us up for a bigger crash, and trillion-dollar deficits when the economy was supposedly good. So as an economist, I generally lean Keynesian, but if I were an Austrian economist, I would be screaming, why are we running deficits when the business cycle is good? So I think a Keynesian and an Austrian can agree that we shouldn't be spending a lot of government money when the economy is good. In fact, we could even, to avoid inflation in certain circumstances, shrink government largesse. Now, I don't believe that makes sense in the short run, and I don't believe it made sense in the last decade because we were facing a massive deflationary issue. And because of the way demographics work, we're going to continue to face demographic issues, deflationary issues derived from demographics. So as the population gets older, people spend a little bit less money as they get older, and then less money, and then less money, and then suddenly they have healthcare expenses. And the last year of life is very expensive, but it's concentrated spending on healthcare. And we're never really going to see population growth the way we have in the last 100 years. So we have to cope with the idea that growth in the economy is not perpetual from an organic standpoint. Slow growth forever. You've all read my report by now, I think. So the whole slow growth forever economy ends up being even more damaged when wealth inequality is concentrated as it is. So Pew Research Center did a really good piece on social and demographic trends. I think the demographics are overlooked over and over again, but if we don't understand what's going on in the demographic realm, we'll never understand economics. And if we don't understand economics, we're probably not really understanding our investments. And I think that a lot of people who are invested, Robinhood investors, some of the people on Reddit, probably most of the people on Reddit, you saw my article the other day or a couple of weeks ago where I talked about the Reddit investors and the Robinhood investors. Your millennial investors in a handful of years, they don't get what they're doing. They're just buying because they think that that's what they're supposed to be doing because the Federal Reserve is printing money. Well, one of the guys that I've been knowing since, or that I've known since my Market Watch days, put something out, and another guy put something out almost simultaneously that it makes you kind of think one of them copied the other guy, that showed that the whole "don't fight the Fed" thing isn't quite right. That there are, in fact, plenty of charts out there that show that when the Fed is doing things to stimulate, it's usually in the face of some sort of crisis that they helped perpetuate. So the financial crisis was largely caused by the Fed. There are a lot of reasons why that happened. There was a perfect storm of hot money, but ultimately a lack of regulation by the Fed and cheap money led to a bunch of other problems. And there were problems from Congress and the executive branch too. Today, we are seeing a lot of money pumped into the markets, into the bond market in particular. And in a few minutes, we're going to talk about that. It's vitally important that we understand that when massive debt accumulates, there's got to be two things that happen. Generally, it takes a very long time to pay off debt. But the other thing that almost always happens is at some point liquidity gets too tight and there's an event. And that event really beats up markets. I believe that we are probably in the most dangerous time for debt than we've ever been. We have a worse debt scenario right now than back in 2007. I don't know how it resolves. I have some ideas on how to avoid a crisis, but there are people who will scream and yell bloody murder at using those remedies. because they end up solving two problems. And I've talked about what some of those remedies are. But to solve the debt problem, the Federal Reserve, which owns all sorts of corporate debt now, and the U.S. Treasury, which owns all kinds of stock options or stock warrants on corporations or equity, and a lot of it's direct equity. If we really wanted to prop up the economy and solve two problems, kill two birds with one stone, we would take all that debt and all that equity from the Fed and the Treasury, and we would use it to seed a Social Security lockbox, whereby that lockbox, because it's super long-term, can absorb the risk, but it can also take on all that long-term debt and equity and pump it into our retirement system, which is going to need help in about 10 or 15 years. So there's a way to solve a debt problem and solve a retirement problem if you put the two ideas together. I don't know if that will happen. In the meantime, we have to worry about serious problems with debt and with wealth inequality, because if 80% of the people can't make it, if 80% of the people can't pay a bill that comes up unexpectedly, like a car repair, if 80% of the people are struggling with paying their rent after 2 or 3 months of being unemployed, we've got a massive problem as a society. So we need to solve problems that don't include austerity or contraction, because otherwise we're going to see a massive stock market crash that is way beyond anything that the Fed could print its way out of without causing hyperinflation. So the income inequality ratio has gone up dramatically since 1980. The Gini coefficient is a measure of wealth dispersion. We are at one of our worst points in history. We've been as high as about 50.59, which basically means that all the money is in the hands of just a couple people. But we're seeing that, going all the way back to here, is when so few people have so much of the money. What we've seen is that the upper income portion of the earners now are making 79% or have 79% of the aggregate wealth. Upper income 20 years ago was about 14% of the population. It's now about 20% of the population. About 20% of the population would be your higher income earners, your 6-figure, 7-figure earners. The middle class, though, their share of wealth has dropped. And then lower income has basically nothing. So you have 80% of the population with about 21% of the money, and 20% of the population with about 80% of the money. That's a problematic 80-20 problem. The gap in upper and middle income is dramatic. 20% of the people are earning more than pretty much everybody else. Now this chart is a little bit out of date, but really the top 5% of people are the only ones that, as of 2016, had made any money since the Great Recession. Now that's higher now. This group is in there too. So 20% of us have made money since the Great Recession. 80% have not. Their situations have stagnated or gotten worse. Again, the frustration that builds and then a trigger ignites it, a match. So the top 5% have captured virtually all of the gains. There's another chart out there I don't have up. But if you're not a top 5%er, you're not doing great. There's 15% that are doing good, and then 80% of the population stagnating or getting worse for 40 years. That's a generational issue that is manifesting right now. That is part of why we have different types of protests that indirectly or directly are tied to freedom. And I'm going to get to a couple of ways that I think freedom could be improved and would improve our investments. So the highest 20% of people, again, getting most of the money, top 1%, big hunk of the income. One of the biggest problems I see out there is that executive compensation has run off the rails, and you're talking literally trillions of dollars in the last 40 years have flowed to 1% of the population that make up the executive suites. I'd ask you a question. If they deserved that money, what would be the parameters that they deserved it under? Would wealth inequality be what it is? Would problems with unemployment keep reoccurring? Would we be running such a massive federal deficit? I contend that America's corporate executive class has failed. And I think it's failed en masse. I think that you're probably looking at 80% of the executives out there are more involved with lining their own pockets than they are helping not only shareholders, but their employees and society. The idea that pure profit motive is what drives things is kind of bastardized. Because if that were true, the executives wouldn't make so much money. More money would go to the corporation in the form of profits and then distributed to shareholders. And probably people would have seen more than an aggregate 1% rise in incomes. It's 1.2%. The average rise in incomes in 40 years has been 1.2% in real terms. So that's a massive problem. And this idea, the executive compensation, right, could have gone up 940% since the Reagan administration, basically, versus about 40% for the general population. We have to really start thinking, is that egalitarian? More importantly, is it really meritocracy? Is it really a meritocracy? Or is it a function of captured boardrooms that steal money from you as shareholders? And one of the things I would encourage you to do is study this issue. And when you get your proxy statements, you should vote against almost every single compensation package that's out there. And you should almost always side with the people who are calling for lower executive compensation. Why? Because it won't get completely enacted. This idea that you make it a black or white, no. You just need to pull the wages back. And to the extent that it occurs, it's a small victory. Executive compensation should probably be about half to maybe even 1/5 of what it is. So a 50 to 80% decrease. And they would still make 10 to 100 times more than the average worker. That money would flow to the average worker and to the shareholders. That would be very, very good for the economy. It would be a positive feedback loop rather than the hoarding that occurs among this billionaire class and multi-hundred millionaire class that never gets recirculated as capital back into the economy, never increases anybody else's standard of living. When 80% of the population hasn't really seen an increase in standard of living in 40 years, that's a problem. And we're getting a snapback now. It's why Bernie Sanders was popular. He would have just introduced a new set of bad problems. But when we let the pendulum swing from so high to one side and far to one side, well, the momentum to the other side is going to be just as strong as the pendulum swings back. We need to pull to the middle. We need to focus on freedom. We need to focus on fairness and productivity and all those other things that make the economy go. Right now, we are at a ledge that I have seen coming for a long time, 15, 16, 17 years. I started to figure it out right around 2005 and 6 is when I started to figure it out. And we've had a financial crisis, and we've had a pandemic that has all sorts of protests somewhat related to it on one side and not really related to it on the other. But ultimately, a lot of it is pent-up frustration. And I will tell you, there is no goddamn way in hell that this economy should have tanked as bad as it did. Even if we had shut down for 12 weeks and paid everybody to stay home, which is what we should have done. You heard me saying that in March and April. If we had shut everything down for 12 weeks, told everybody it would be 12 weeks, and this is what we have to do to beat this, and sent everybody a check to pay 3 months of expenses, we would have A, spent less money, because we're at trillions of dollars in the corporate bond market now, and all these other programs that we have. And it actually makes me angry that we're still arguing about how to do things, because it is so self-evident on what we have to do. And we're not going to do it because we're pinning our hopes to a vaccine that probably isn't here until next year sometime. And the first couple of vaccines aren't going to prevent the disease anyway. So our freedom, right? People said, oh, why do I have to wear a mask out there? Well, it's because that one slight infringement, and it's an infringement at a certain level, prevents other people's death. I would say that weighing the two, wearing a mask versus possibly causing somebody else's death by disease, I think dying, causing somebody else's death, is probably more of an infringement on freedom. All right. So I would like to get to the investment part, but I want you to see these headlines. Right? So corporate boards cut executive pay, but get this, right? So that was the headline, cut executive pay. They're so magnanimous, right? But then they gave them low price stock options and stock during the crash. All these executives have made money on this rally. They should have just been net even, correct? Why did they make money on the V so far? Shouldn't they just have gone straight across? But no, small pay cut, a whole bunch of stock options at the bottom, and then they made money. So executives have made money on this pandemic. Wall Street Journal is starting to point that out, that we got big problems. When the Wall Street Journal is pointing out executive compensation issues, you should stop right in your tracks if you're trying to say, well, they deserve it. Bullshit, they don't deserve it. They have failed as a group. Not that there aren't some successful ones, but as a group, they've failed. And they're stealing from you, the shareholder, and they're stealing from you, the citizen. This is a statistic that I'm going to put in an article, maybe by tomorrow's article, but I think I'm going to separate it out. The amount of debt that the United States has taken on since 1981 is roughly the same is the increase in wealth of 1% of the population. Let that marinate for a minute. The amount of debt taken on by the United States, about $20 trillion since 1981, is about the same in the increase in wealth of 1% of the population. It might be 2% of the population. In other words, we all borrowed to subsidize and steer wealth to 1 or 2% of the people out there. And really, it's very top heavy. You're talking 30,000 people in the country have gotten that money, is what it comes down to. And you can find that statistic. There's this thing out there called Google. Financial Times is talking about it. When the financial press is pointing this out, you got to think, where is this snapback going? Will all the results of the snapback be good, or will there be medicine that's worse than the disease? Now, I think that there should be caps on CEO deductibility, the pay deductibility that corporations get. So right now, if you're a corporation, you can deduct pay. Well, over a certain level, it shouldn't be deductible anymore. Why would executives, right, who get millions and millions of dollars, many of them who are failed executives, and then they just shuffle to their, they go to be on their buddy's board, and then they end up getting a new executive job, basically coming out of the elite universities, Yale and Harvard. There's others, but there's a class that's basically buying American corporations and sucking in this wealth, and that damages all of our freedom. If you talk to anybody who was around in the 70s and working, just regular people on assembly lines or whatever, and I'm not saying those are the jobs that should come back, but the structure out there was, if you worked, you could get ahead. That's basically how it was in the 50s, 60s, and 70s. If you worked, you could get ahead. That started to go away with the union busting and other rules in the 80s. And I'm not saying unions are great. I'm just saying that when you took away a lot of collective bargaining power, you started seeing a deterioration in the middle class. So yes, there's problems with unions, but there's bigger problems with not giving people a raise for 40 years. 1.2% on average is the annual raise for most people in the population for the last 40 years. But corporate executives' pay has gone up almost 1,000%. Just keep wrapping your head around those numbers. Where really is that pay raise for the executives coming from? It's coming out of everybody else. And it's been trillions of dollars over the last 40 years. Trillions. Right? Trillion here, trillion there. So Harvard Law School actually does some pretty good stuff. They, their MBA guys end up, or MBAs end up winning the world, but it takes all types, and they point out the role of a public company. In the 1800s, an American company had to have a charter that showed some purpose. They had some social positive outcome. It used to be a law. They got rid of that, I think, right before the Roaring 20s. And that's when it just became profit motive. Everything's profit motive. Everything driven by profit. And that's part of an economic theory that's wrong. I think it's interesting that Will Ackman's right here. Tell you what, Will Ackman's an arrogant guy, right? And he's clearly an opportunist. But he's another guy that kind of points out the right problems. So while you may not like him, and I'm not sure if I do or don't, he's an interesting guy, and you should follow him when he talks. Because if nothing else, he's saying something that's interesting and you should think about. So the bailouts, and we're getting to the bond part and the investment part, the bailouts have some executive pay limits. The Main Street Borrowing Act, which is just getting off the ground, is for mid-sized companies. And if you take a look at it, the restrictions on mid-sized companies are greater than restrictions on big corporations. I think it's just kind of amazing that we make it harder on the little guy over and over and over again. These small and medium-sized businesses are the backbone of all the innovation in the economy. And yet, when a corporation has made it, then we start to give them all the breaks. Isn't that upside down? Shouldn't the breaks go to the people trying to get things off the ground and improve things and create competition, which is good for consumers? And shouldn't we foster entrepreneurship and innovation rather than giving the breaks to the giants who end up stifling competition and stifling innovation? What I'm telling you is at some point, you're going to see a snapback. And I think it's close. I think it's a lot closer than a lot of people think. I don't think Joe Biden, who I've been telling you for 2 years now, was going to be the next president probably in a landslide. I've been telling you that he'd win in a landslide for about 2 years now. Before he was the nominee, before he was an announced candidate. And it wouldn't have mattered if it was Biden. Somebody was gonna from the Democratic Party was gonna win probably. So there's a fun website. If you ever want to see what an executive is making, AFL-CIO Paywatch. Just go to aflcio.org Paywatch, and you can learn what an executive is making. So I have no idea what Nvent Electric is. It just is one that popped up. But whoever this is made $4.6 million in 2018. Okay. Now, without a frame of reference, that might not be that big of a number. I don't have a lot of problems with people that make a few million bucks. I don't. If we can pay baseball players $20 million, I'm cool with an executive making $20 million here and there based on performance. And it should be structured. It shouldn't be in lump sums. It should be spread over time. But if we go to, let's see here, let's pick a symbol. Let's say ORCL. Oracle. Look at that. Oracle. $1 million, 2018. Oracle's monstrous. Now, my guess is there's an anomaly here, and there's probably some stock awards that weren't awarded yet. But this is what you should be seeing, right? 12 times the median employee's pay, $1 million in salary, basically. Then if they made 5 million or 10 million in stock bonuses over a number of years, I'm cool with that, because that means that we're on their side. But what we're seeing right now is a problem. So let me take a break, and then we're going to get into the investment side. And the break is, I have a new Medium page. So I am the Ignored Xer. I don't know. I might change the profile name. You guys can search for this and find out who it is. But I'm old enough to know a lot of things, young enough to care. Weird mix of liberal and libertarian from flyover country, and I have a lot of East Coast friends, and I tease them because some of the things they say are so dumb. I'm like, dude, you need to get in your car and drive through Pennsylvania and Indiana and Ohio and Illinois and keep going through Wisconsin, head over to Iowa and Minnesota, and then come back through Michigan. because, you know, head to Nebraska if you want to, some other places. I'm telling you, so much stuff gets made here. Wisconsin's a big manufacturing hub and grown in this part of the country, that when you realize that what you're eating and wearing and driving is all from flyover country for the most part, it gives you a different perspective. So like when I go out to New York, and I love New York. I mean, if I could afford it, and I probably could if I worked there, you know, I'd love to live anywhere near Central Park, any side of it, doesn't matter, right? And really anywhere in Manhattan. I just don't know how anybody can say anything bad about Manhattan other than, man, it's busy. It is packed. People stacked on top of each other, which, as I said, well before the pandemic, I said some of these massive cities, right? I don't understand. I think after I came back from the East Coast 2 years ago, I said, I don't understand why 1 million people don't move out of New York tomorrow. It's too full. It's going to cause diseases and pollution and everything else. But we flocked to those cities because there was an idea that cramming people into cities was good for the environment. And that turned out to be bullshit. Right? That turned out to be wrong. Why? Because we have technology now that's going to let us live anywhere we want and not have to move around as much, move around when we want to. A lot less commuting. Between the EVs and IoT, right? So while we were packing people into cities and doing something unhealthy, technology was fixing all those problems. And had we just waited for 20 years, we would have had to create a cesspool like we did in 100 major cities around the world. There's enough space for everybody. There's enough resources for everybody. One book that you should read, and maybe it'll be on our list in the new book club, is Age of Abundance. I think that's what it's called. I haven't read it yet. I've seen it. I've read the Cliff Notes on Amazon, whatever they call those Amazon notes. And it's true. For the most part, we have more than enough food. We have more than enough resources. We've overproduced. The supply side economics of the last 40 years has created a glut of almost everything. Now, distribution is screwed up because everybody hoards. But there's a lot of things that say the world could be even better than it is today. And there could be almost everybody could be living pretty well. You know, 80%, it should be upside down. It shouldn't be 20% of the people living well and 80% of the people struggling. It should be the other way. 80% of us should be living pretty well. And only 20%, you know, having to get help. And I say that as a guy comfortably in the top 20%. And I say that knowing I could double my income in 6 months if I wanted to. I'd have to work 80 hours a week. And I have to do some of the things that other guys do, other people do. I don't want to do it. I don't want to give up my freedom, my time. I'm 50 now, right? I'm a high energy 50-year-old. Should have seen me when I was 35. But I didn't have good guidance early in my career. I figured it out in my 30s. By 41 years old, I was internationally published. And I think that I'm just lucky. And I work hard. I'm pretty smart, but I'm lucky. And I'm a white guy. That helps. I think it helps less than it used to. But clearly, I get advantages, and I know I've perceived it. So I think that if we want to make sure that our freedom is secure, we have to focus on all these other issues. We have to make sure that our corporations are run well so that as shareholders, as people with capital, we are appropriately compensated. And we shouldn't complain when an executive says, look, the dividend increase is going to be lower for the next several years. We got to give everybody a raise. Otherwise, in 3 or 4 years, we're going to be less competitive. That's a smart long-term business decision. But yet we cry because, oh my God, they only increased the dividend 1%. Well, that is the average annual increase in wages. So my first article, which will be out tomorrow on my Medium page, is freedom is in the hands of the millennials now. And I believe that. And what we have seen in the markets is that the millennials have started to take over the markets. Now, they don't have enough money to do much to a heavily traded market and to a market where foreign money and boomer money comes back. But I think boomer money is going to not come back so fast because I think a lot of them are just fearful. So I don't think there's new boomer money out there. Now, there's some boomer money on the sidelines for people who take a tactical approach, right? They pull back once in a while, then they push in once in a while. But I will tell you that money for the stock market over the next decade is going to be this money that the government creates, and as the millennials generate higher income. I'm going to tell you something about the millennials. They are way more focused on their personal freedom to their detriment at the moment, right? They think they're doing great because they're making money in the stock market, but they're also spreading the disease. They're not being responsible. But ultimately, over the next 10 years, the millennials will drive everything. Everything. And I think that that's important to realize because we've talked about that in the investing in the 2020s. We have to be on the side of the millennials. We should be on their side as investors. We should be on their side as mentors. We should show them some respect because they save more as a percentage of their income than any of us ever have. Did you know that? So I think that as they make decisions, small micro decisions at the household level, all the way up to how they vote and how they run corporations, because they've caught up quickly, right? They started out behind because of the Great Recession, and they have caught up quickly. Why? Because they have some drive, and they have a chip on their shoulder, and they don't want to be indebted in general. And that's not all of them, but I think that's a pretty good stereotype to attach to them. This idea that they're lazy, I think, you've got that one group of millennial men who have never really worked in their life, and they're in that shithead category that I've pointed out, right? There's that shithead category of society that you can't get rid of. They're either lazy or corrupt or whatever it is, some single-digit percentage of the population that just sucks. Nothing you can do about it. You just have to figure out a way to work around them and make sure they don't cause trouble. But the rest of the millennials, especially the women who I've been very impressed with, and that is not a dirty old man thing to say. I just think the women have been very driven. I think they're 3 or 4 generations now into the workforce, and just working for the sake of working isn't good enough for them. They want to get ahead too. And they contribute a lot of great ideas and a lot of good leadership. And in fact, I specifically copy several female investors because they're good at it. ARK Investments, Kathy Wood, she's one of them. My aunt, Jean, Executive Vice President at Baird for years. So there's a lot of good investors out there. A lot of them are women. A lot of them are millennials, and they're figuring things out quick. Now, there is a level of inexperience right now with the just getting started group that just buys because the money printer goes burr. And they'll learn, right? They'll learn. But eventually, things work out, and we have to be smart about how we invest. And when we invest, we have to know what parts of the economy are going to do well, and the millennials are going to be driving it. So we should have that in the back of our mind all the time. The folks who tell me on Seeking Alpha that they will never sell Exxon, that's fine. I need them in the market so I can short the shit out of Exxon. You know, I'm gonna fly over the country. We swear once in a while. I know nobody swears on the coasts. In the middle of the country, we do. I'm teasing you. I'm always teasing. So I'm gonna short Exxon. That was one of the bets that I took this week. I started shorting Exxon on Monday. And we talked about it on Tuesday in our webinar. So if we want to be on the side of the millennials, we're going to have an approach, right? So let's talk about the bond market. The bond market is seeing the biggest wave of Fed purchases ever. The law was actually changed to allow them to buy corporate debt. That wasn't legal before. So the quantitative easing of Ben Bernanke was such that money went to the primary dealers, your Citigroup, JP Morgan, everybody else. And they in turn would lend it out, usually to investors. And that pumped up the economy before. And there's an idea that all quantitative easing is the same. Not true. Because the quantitative easing of this Fed, of the Powell Fed, is going to the corporate debt market. What does that really do? How much of that money really filters into the stock market? Well, based on the falling volumes of people buying stocks in the last month or so, it is clear that not a lot of that money flows into the stock market. This is money that's going into corporate bonds so that companies can refinance things and push out obligations and stay in business so that when we come out of this pandemic, which will be next year or the year after, they start employing people again. And I will say that I am somewhat encouraged by the fact that Americans are just too focused on themselves to stop buying stuff. I mean, I thought that we were going to see a 15% contraction this year. It looks like it's going to be closer to 10%. I'm impressed by that. You know, I am impressed with Americans' fortitude in the face of this, but I'm also depressed because people, as a political statement, aren't wearing masks, and that's causing a spread. So between the young people thinking they're invincible, and which is right, we all think we're invincible when we're young. I'm in that middle age period where I want to be invincible, but I know better. And then other people who aren't wearing masks because, hey, take away my freedom. Come on now. We've been over that. Accidentally leading to somebody's death is taking away more freedom than you having to wear a mask. So take a look at some of these articles on corporate debt, and I'll summarize for you. The Federal Reserve is helping create the biggest corporate debt bubble in history. So while it's good now, right, it's keeping these companies in business now. I mean, we'd have seen a lot more bankruptcies if it wasn't for the Fed. There is no doubt about it. A lot of those companies are just deferring their death. Because of the companies in the S&P 500 and smaller, I mean the entire Russell 3000 biggest companies, I would say that fully 10 to 20% of them will be out of business by the end of the decade. And yeah, there'll be some mergers, some takeovers, some take-unders. A lot of them are just going to run out of ways to make money because the economy is changing that fast. One of the places is commercial real estate. A lot of debt out there in commercial real estate. There's going to be a lot more vacancies in offices. and there's going to be lower rents. Because corporations are going to realize, maybe we don't want people coming in all the time because we lose productivity when people get sick, right? So there's an equation. What is the equation? The equation is we can contribute to our employees getting sick less often by having them work from home. We don't lose that productivity time, right? Because if you're in an office and somebody who's key to doing something gets sick for 2 days, right? You lose that time. People end up getting paid for doing nothing because there's a knock-on effect. Every manager out there knows that. But if everybody is working from home, or people can work from home more often to prevent the sick days, right? Now all of a sudden productivity actually doesn't go down because people are working at home. And that is actually what corporations are finding. Corporations are finding the productivity has not gone down at all with the work from home approach. So I know a lot of you are managers. I would think it's rare that you see a decrease in productivity. I mean, maybe on an individual basis here and there, but you probably had problems with them when they're in the office. So I believe that U.S. corporate debt is going to be a massive problem, because this is an old chart and it is way up here now. So I'll get the new chart. And this flood of corporate debt is going to potentially cause problems for companies to reinvest in their futures because they have to pay off the debt. My suspicion is that the Fed takes it easy on them at some point, probably refinances them again in 3 or 4 or 5 years, right? Because this debt that the Fed is taking on is all supposed to be 5 years or shorter maturity. Most of this debt will get stretched out. But how does that manifest itself with shareholders? What does that impact on shareholders? Right? Fewer stock buybacks for sure, and slower or no dividend increases. And there's, of course, all these companies that are reducing their dividend. Simon Property just reduced their dividend 40%. And that was mainly to save face. They should have just gotten rid of their dividend. But they're a REIT, and they're afraid of losing investors if they get rid of the dividend altogether. So it costs for them to maintain an investment base of shareholders to keep the dividend. And who loses a lot of money if share price is down? Corporate executives. So the smart thing to do, well, the smart thing for Simon Property to have done, is they should have taken it on the chin. They should have cut their dividend completely, let all the dividend chasers leave, let the people who come in knowing, let investors go in knowing that, hey, this is a company in transition, but they own real estate, so they can make a lot of money in the long term. They should have gotten rid of that stupid dividend altogether. And then guys like me would have bought Simon at 20 or 30 bucks a share and said, okay, let's figure out what to do with all this beautiful land. But they made a short-term decision based on probably executive compensation and Simon family money, right? Because they collect some of that dividend too. It wasn't a good executive decision by Simon, and I think it's going to hurt them. I still think that they have to cut their dividend again. And I think the stock goes down to 20 or 30 bucks a share. So whether it was today or in a year or two, whatever, their properties are in big trouble, but it's still land. And it'll be redeveloped. That'll be expensive. And that is how you think about a company. That is how you think about corporate executive decisions. How does it really manifest 2 or 3 or 4 years out? Or do you just think about, oh my God, I'm getting a 7% dividend? Stock is down 50%, but I'm getting a 7% dividend. 7 years, I'm back even. It's a bad way of investing. So I just thought I'd throw this out there. Goldman Sachs, the vampire squid, as it were, says the economy would be better if everybody wore a mask. Did you realize this? Has anybody ever suggested that the economy would be better if we just wore masks? Never heard of such a thing. All right, so let's talk about investing. Get in real deep here quickly because I only want to do 10 more minutes. I know that people who saved a lot of money on the downside and really have only made money on the gold, which is up over 50% that we bought, and a couple bottom fishing things, would like to have been more invested during this rally. I get it. Me too. I have been a sector investor for a long time, and I should have pushed this approach more, but on margin of safety investing as seeking alpha, a lot of people are conservative investors. But you get this big mix. So I'm going to add the sector rotation trading strategy that I've used for years. It's been very successful. I've beaten the market by between 4 and 8 points on average every single year. And I've had years where I beat the market by 30, 40, 50 points. Very simple is, and we've talked about this, Zacks has research out there. There's all kinds of white papers out there that show that being in the relatively strong industries, and there's about 40 that I track, being in the relatively strong industries, you'll beat the market by a lot. So the stocks within the sectors, and this is just sectors, and you can break this down to a spider trading strategy, but it's even better if you break out some of the industries. So if we avoid the worst ones and get into the strongest ones, and we'll have some of the ones in the middle just by, that's the way it'll be. But if we cut out 2 or 3 sectors in general and focus on 2 or 3 sectors in general, and then have some diversification over here, we'll generally beat the market by 4, 5, 6, 7, 8 points a year. And that's just by being a little bit better than the average on picking our sectors. So this is what I'm incorporating into services. I've always had it. I just didn't offer it, and I should. It will require you to trade a little bit more often, not a lot. It's not going to be weekly trading. It'll be, most of the trades will be 6 months to a couple of years, but you'll want to adjust your asset allocation, and you should look at your portfolio, once a week, just to know what's going on. But you probably won't enter trades but once a month. And if a limit order gets there, a limit order gets there. So you have seen on my new charts, where's my QQQ chart, that rather than putting in more lines, because I want you to see the Fibonacci levels, because you can see where the confluences are, right? Where multiple Fibonacci levels kind of pile up on each other. And those are natural resistance and support zones, because it's what happened in the past. It's what's probably going to happen in the future, give or take. Not perfectly, but give or take. So what I'm doing is I'm just going to put in a buy zone for you. The bottom will be the bottom fishing price. So on QQQ, the bottom fishing price is 145. But you could probably start buying it around 192. And you do your scaling in every 5 or 10%. So at 192, and then what's 10% of, so 20 points down, maybe 172, 73, 175. And then our 10% down, so another, now you're down at 160, and then you have your last scale in down here at 145. About every 10% down, you scale in again. Why about every 10% down? Because most corrections are somewhere between about 15% and 55%. So from 252 down to 192, that's already your 20% bear market. And then a 30, 40, and 50%. down, you're buying 40%, whatever that is, right? Pretty easy. So I'm giving you buy zones. You should probably, if you're not invested in something, you nibble in at the top. If you are, you can ignore the top of the buy zone. And then you buy down in here, and in here, and in here. There you go. Very simple approach. And we will pick out many different sectors, right? So we know that we have certain things that we want to be in. And there are some international plays that I've been eyeballing that we're going to be looking at. So in the ETF favorites, very short lists, we're going to see some slight changes in format because I want to give you the very best ETFs. So you can find your own equivalents if you want because your brokerage does something for you. But really, most trades are free anyway, so what does it matter? So I'm just going to focus on the funds that I think are the very best at the industry level. We'll keep tracking the spiders as well. But I've got those 40 ETFs. They're basically, hey, these are the ones we're going to use. And if you want to find an equivalent because you prefer Vanguard, you prefer this fund family or that fund family, that's fine. You're splitting hairs. Because at the industry level, the ETFs are all fairly similar. Some are equal weight, some are top end weighted, you know. So you really just have to figure out what is best for you given your brokerage situation. Now, just going to take a look at the very short list plus, because I have stocks on this screen that I used to cover that I keep track of still. I just want to show you that the money flow index is from almost overbought to overbought across the whole group. And the relative strength index is overbought to almost overbought. Not overbought, but almost overbought. And when these stocks in the middle, you have to figure out, are they heading up or down? Let's just take a look at one. Let's take a look at Lockheed Martin, one of my favorite companies as far as an investment goes. Oop, wrong one, wrong color. So I want to show you just how to look at these stocks. So I do the Fibonacci levels, and I've only done 2 sets here. So this is what's called a swing bottom or a pivot right there. And then the swing top, the long-term top was there. Now, we could do it off of here as well, because realistically, we had that first top, 2018. Make sure I get my lines to match. I think that's right. Looks like it's off by just a hair. Oh, that's right. All right. So based on what happened from 2016 to 2018, these are your actual Fibonacci levels because that was the first pivot. So what we would do to get the more recent time frame is we go and take this bottom to that top. And that gives us a new batch of Fibonacci extensions, retracements, excuse me. You see, I put the longest duration one on the far left is green. Then the middle one is blue. And I guess we could do it that way. There we go. Say, okay, so where are the confluences? Right around 250. Look at that. A couple lines here at 250. So let's take a extension. Say, okay, from this bottom to this top to this bottom. You start to go, right in here was huge resistance. Stock got into this range and could fight its way through to this big gap up. So it's probably going to head down. And I would say that right around here, make it easier for you to see. Right around here is 290 range. Got 3 levels right on top of each other, a confluence, where multiple resistance or support levels meet or are close to each other. Pricey Lockheed Martin go down to a little bit under 300. A 20% drop. It'd be roughly equivalent to where it was. If you get that chance to buy it at this low again, I think you have to sniff around. Now, the next level down is around 250. At that level, unless something's happened to the company that's bad, you probably have to buy a lot of it at that point. I think you buy some of it a little under 300, a lot of it down to 250. So our buy zone is 290-ish, 250-ish. And I've been deliberately putting these out to autumn of 2021. Why autumn of 2021? Because typically the market gets its correction in the autumn. Here we go. And we know that usually this, the best 6 months of the stock market are November, December, January, February, March, April. You've seen those studies that if you were out of the market for 6 months and in the market for 6 months, you actually would have beat the market over the last 50 years or 70 years or some long period of time. So our buy range on Lockheed Martin is somewhere in the 290s to somewhere in the 250s. Is that easy to understand? So you see where the confluences are, and no point in me putting in more lines. I like the box better than me having red and green and blue lines. I want you to see the Fibonacci levels. I want you to understand that these are areas where there's support and resistance. And support and resistance can get violated once in a while. But usually, if the chart you're using doesn't confirm 2 periods in a row, if you're using a daily chart, it has to be above resistance 2 days or below support. You know, it has to be above or below for 2 days in a row to know that that level has been broken. And again, you have to determine what type of trader you are. This is a weekly chart, right? This is just for the big picture people who want to buy it when it gets in that time zone, and they're not going to bother selling it until it gets way up here. And I ain't going to watch it for a while. But if you're a swing trader, right, all of a sudden you see, well, gee whiz, look at that. If this goes below this level, right, look, it's right at this confluence. If it goes below this level, it's probably getting down here. You know, I think 325 is a pretty given at this point. Would I buy it at 325? I love the company, but it's not quite cheap enough for me. I want a bigger margin of safety. So ultimately, when you're patient and you get these opportunities down here, like I know somebody bought Apple at 220. I'd be selling Apple right now. But I think that if you can get some of these stocks down here, you're going to be in great shape. Let's take a look at Apple real quick. Okay, so we'll do a new chart because I still have the old one up. There we go. First Fibonacci retracement. So we're going to go to 2016, it looks like. Go to this first peak. It's your first level. And then we will do a extension. peak to peak, and then the next bottom. So interesting that this terminated right about at that 0.618 level. The 0.618, for whatever reason, is a weird Fibonacci level that has gained a lot of popularity in the stock market. So people aim for those. So this 380-ish level for Apple, it's a long-term extension. So let's take a look at the nearer term, see if it confirms it. So we'll go from here to that top, right? So it went through this Fibonacci level. Market didn't care about it too much. Let's look at this extension. Again, bottom, that peak, then back to this bottom. What you see, there's a couple of levels up here, about 372 to 382, where you're probably going to see Apple have some pretty significant resistance to going through that. Now, 400 is a nice round number, and a lot of times the market will pull towards 400. And look at that. There's another one up here at 413. So somewhere between here and here, you probably get a reversal in Apple. Why? Because clearly they're not worth this much. Based on what they earn, they're not worth this much. At some point, the market cares about earnings. Not often, but occasionally, when it does, it's pretty significant. So, in that time frame, there will be an earnings announcement or an event, or somebody will say something, or something will go on. So I would suggest that we make this color change. The colors will repeat over and over again. So the longest one is the pink. The more near-term one is the purple. Sometimes I will put in a third set. Not often. It usually means that I'm not quite seeing what I want to see. Usually 2 levels. Long-term, right? Your primary wave, if you're an Elliott wave person, your more recent. Then your long-term extension and your short-term extension. And what you can see is probably, right, in here is where it's going to turn. If it breaks through this 413 level, maybe the economy is reopening, we have a vaccine, and everybody's just giddy. And then it zooms all the way up to 500. As a risk management technique, I think you probably should be taking some off the table as it gets into this area, right? Go back to our weekly chart because, again, we're primarily position traders. Well, there we go. Pull this over, say, where is our buy box? We're going to say, I'd want to buy Apple. Yeah, where would I buy Apple? I guess our bottom fishing has risen all the way to about 240. I can't see it getting back to 220, to be honest with you. I mean, all these levels here are close enough together that for it to go down this wall of worry, right, for it to climb the ladder down, bad things would have to be happening. So I think that our new bottom fishing is at 240 there. I think, oops, that's the wrong kind of line. What did I do? Oh, I used the wrong rectangle. I've done that before. There we go. Right, start of that confluence. So we go all the way to here. If you really just loved Apple, I think you could buy it there about 320. Why? Look at that. That's a peak right there. Came down. Could just go test that and then zoom back up here. Could. You have to decide how bullish you are on the stock. I don't think I would buy it way up here. And in fact, I'm not going to attach my name to that. I'm going to go down to this level because that's a strong confluence, right? You got 3 different fib levels there. If you want to buy up here, that's on you. You might be right to do it, right? I'm not claiming to always be right. I'm just looking at risk management. And I realize, as an investor and a poker player and a guy who dated, there's always another chance, right? Took me a whole bunch of chances, and now I got the perfect girl. My poker game's pretty good. My investing's pretty good. So I think that if you manage your risk first, don't get FOMO'd out. Oh my God, I might miss this move. So what? Go get this move in another stock then. Manage your risk. And as I've said, I think that Warren Buffett is going to sell more of this stock. And I think the stock market's going to be very concerned when it hears that Warren Buffett is selling Apple again. Remember, he sold 750,000 shares last fourth quarter. And he said he wouldn't buy it above 200. Now, I don't think that's true. But I could see him selling in here 1 million or 2 million or 3 million shares. Why? Because it's super liquid and he likes cash. And he thinks there's a crisis coming because of the corporate debt and the unemployment. How much firepower does the Fed have? Who knows? They say it's infinite. Maybe it is. But if they just keep printing money, at some point we go inflationary. And if you have slow growth and inflation, some of you remember this, it's stagflation. I'm still in the camp that we're going to have stagflation soon, like after Labor Day. And it won't be horrible, but it'll be noticeable. And we've already seen the meat prices go up. But some supply chains are still a little bit thin, a little bit disrupted. Corporations don't want to invest in China anymore. They're starting to move things back, and that causes periods of time where there's a lag between what they want to produce and what they can produce. And then you've got all these sick people. Then it's getting worse and worse and worse. So I think we're going to see some pullbacks. I think they're very investable. I'm very bullish on the rest of the decade until there's another crash. But we're going to get a heck of a rally off of whatever this correction that turns out to be that's coming. You're going to want to buy the correction. So if you're uber bullish, buy QQQ just under 200. But scale in every 10% or so that you add more. Invest your money. Maybe if you have $100,000 to invest your first $30,000 and then your next $30,000 and throw in your last 40. Break it up into probably 3 tranches. You can break it up into 4. A lot of times I do a quarter of my money, and then half of my money is how I invest. And sometimes the half isn't any lower than one of the other 2 quarters. Sometimes the trend just turns positive. I'm like, okay, let's get on this trend. You can't be perfectly precise, but these indicators down here are very helpful. Volume has been going down. That is not bullish. RSI is almost overbought again on a weekly chart. Okay, so we could be seeing the end of the bull rally this coming week. Money flow index way overbought. Shaken money flow is falling way down here. Could go negative in a week or 2. That's called a negative divergence. Be very wary of when price is going up, but shaken money flow is going down. As I've said, shaken money flow indicates one of 2 things when it goes below 0. Either a choppy market or a down market. So that means you really should be a seller up here if you own something. MACD is pretty extreme, right? When these curves go like that, you should, right? Remember that old song, things that make you go, This is not a healthy looking curve. I thought the market might top on Thursday, and maybe that was it. But I think in coming days after the 4th of July, you probably see your market top. It might happen as soon as Monday morning. Because people took money out of the market on Thursday, the second half of the day, like I told you they would, for the long weekend. Money will go back in on Monday, maybe by Monday afternoon or Tuesday afternoon, right? That trade is exhausted. This is an indicator, is 3 exponential moving averages that I put together, 10-day, 20-day, and 50-day, and it's peaking. This says we're very close to a market top. Now, that's happened one other time, but not on the weekly charts, right? On the daily charts it was happening. This weekly chart is pretty powerful. So could it get all the way up here? Yeah, it could. So I think we're very close to the top. If you haven't written covered calls and trimmed as much as you'd like to, you've got a couple days left. So I owe 7 of you an investment policy statement, and I've got a new person coming on. Sunday, I'm going to work on all those. I got more than I could handle. I did not have templates built. I now have templates built. So everybody will get their investment plan by Monday. So I'll have that all good to go. I've got 2 articles coming out on Monday, and the article on why I'm selling Enphase is on the websites now, and it'll be free to the free people, right, to the Seeking Alpha side soon, maybe today. I haven't noticed if they've published it yet today. So let's see here, pending. Nope. So the article that you already have is still in review. And I don't know if they'll publish this today or tomorrow, but they'll I don't know, sometime this weekend they'll publish it. I don't know why it's not out, to be honest with you, but that's fine. So, all right. Close all this down. Oh, somebody asked me. Remember I said Federal Reserve and Treasury own a lot of stock? So apparently, you know, they lent $700 million to some trucking company. And you know what? I mean, I'm concerned when I see this sort of thing, right? I haven't read the article, I don't know. But there's a stock, the government's getting stock for this. So loaning the money and getting stock. My anticipation is that a lot of this, U.S. taxpayers will end up owning 30% of the company's stock as part of the loan agreement. Teresa put me onto this, one of our subscribers. There is something here that doesn't quite pass the smell test. I don't know what it is. I haven't dove into it. But at some point, you as a citizen are going to have an opinion, and you should have an opinion about what happens to all these corporate bonds and the stock that the government's taking. Does it get filtered back to the executives so they can get more bonuses? Or do we use it to solve another problem? Do we use it to seed Social Security because we know there's a shortfall coming in a decade? I think that's a pretty good idea. So I'll be writing about that. In the meantime, I hope you join me on Medium, and I hope you join me in, my goodness, I forgot to bring it up, the Investment Trends Book Club. So take a look at this. There's a Facebook page. It's like 30 people joined already. And the first 2 books are Getting Started in Technical Analysis. And you've heard me say scuttlebutt, right? Kind of like channel checks is what it is. One of Warren Buffett's favorite books. Common Stocks and Uncommon Profits. So that's that. And then in September, I haven't figured out what book, but I do want to talk about sector investing at some point because I think it's very core to our strategy on asset allocation. And that'll be the September book. I just got to find the one I want to read that I haven't already read. Maybe something by Faber, we'll see. But yeah, these are the investment trends books. Last Wednesday of every month, we'll do a Facebook Live event. You don't have to buy from me. I mean, these are my affiliate links. You can buy anywhere you want. I don't care if you follow my link or not. I get like $1. So yeah, read these books. Now, I do think that every investor, even if you're 70 and just a dividend investor and you're just looking for safety, if you want a better understanding of why the market goes up and down sometimes, this is a great book. Even if you don't keep up and you don't use it much, just the concepts, these 300 pages will help you. And it's interesting. And this is really built for a beginner, right? It's not a text. I'm not going to introduce any textbooks to you. And then this one is actually a fun read. So I think that this is a great book. And I will put a investment trends page up here, investment trends book club page up here, with some other books. You just read them at your leisure. But books that I've read already, I've got like 70 of them on my bookshelf. So I'll do a quick scan of some of them just so I remember what's in them. All right, have a great 4th of July. Be nice, have fun, and, wear your mask. And hopefully this economy is up and roaring again in another year. Take care.